All right, let's dive in. Today, we are going to master one of the most critical documents in all of business, the income statement. And we're not just going to look at it as some boring scorecard of wins and losses. No, we're going to learn how to read it for what it really is, a strategic story. It tells you everything, a company's strengths, its hidden weaknesses, and where it's placing its bets for the future. So whether you're an investor, a founder, or just curious about how giants like Microsoft really work, you're in the right place.
At the end of the day, the income statement answers one single all-important question. Over a certain amount of time, did the company actually make any money? That's it. That's the bottom line. It's the ultimate test. But how a company gets to that number, well, that's where the magic is. It reveals the entire strategy, how efficient the business is, and its overall financial health.
So here's how we're going to tackle this. First, we'll talk about why the income statement is really a story about profitability. Then we'll deconstruct it, breaking it down into its core pieces. We'll look at the difference between a super simple statement and the pro-level version that all the big public companies use. Then the main event, a deep dive into Microsoft's actual numbers. And we'll wrap up by looking at who uses this thing and why it drives such massive decisions.
Okay, let's start with the big picture. I want you to think of a company's main financial reports as a trilogy. You've got the balance sheet, which is like a photograph, a snapshot of everything a company owns and owes on one single day. Then you have the cash flow statement, which tracks the actual cash moving in and out. But the income statement? That's the movie. It tells the story of how a company performed over a whole period, like a quarter or an entire year.
So here's the textbook definition. It's a financial report that sums up all the company's revenues, expenses, gains, and losses. You'll often hear it called the P&L, which just stands for profit and loss. But the most important phrase here is over a specific accounting period. That's what makes it a movie, a story of performance and not just a static picture.
Now, what's so beautiful about the income statement is its structure. It's so logical. And to really analyze it like a top consultant, we have to break it down using a principle called MESI. It sounds complicated, but it's not. It just means we split everything into clean, separate buckets that when you add them all up, account for absolutely everything. And at the very highest level, it's just two buckets, money in and money out. Let's start with money in.
See, money in isn't just one giant pile of cash. It's neatly broken down into two very different categories. Revenue, which is the money you make from your main business, and gains, which is money you get from other one-off activities. And trust me, understanding that difference is absolutely crucial to knowing if the core business is actually healthy. Revenue is the lifeblood, the engine of the company. It's the money you make from doing what you're supposed to be doing. For Microsoft, that's selling software and cloud services. For your local coffee shop, it's selling lattes. And we can even get more specific and split it into operating revenue from those core activities and non-operating revenue, which could be something like a tech company earning a little interest on the cash it has sitting in the bank.
Gains, on the other hand, are usually one-time events. This is the profit you make from selling something that isn't your main product. So if a company sells an old building or a delivery van for more than what it's worth on the books, that extra cash is a gain. It's definitely nice to have, but you can't build a business strategy around it happening every year.
Okay, now for the other side of the equation, money out. And just like with money in, this side is also split into two clean categories that tell very different stories. Expenses, which are the regular costs of doing business, and losses, which are costs from those unexpected one-off events.
As they say, you have to spend money to make money, and that's exactly what expenses are. These are all the costs that are tied directly to generating revenue. We're talking everything from raw materials and paying your employees to your marketing budget and the interest you pay on a loan. These are the expected and necessary costs of keeping the lights on.
Losses are pretty much the painful opposite of gains. It's money you lose from a one-time event. So, if you sell that old company van for less than it's worth, that's a loss. Or, if you unfortunately have to pay out a bunch of money for a big lawsuit, that's also a loss. It hurts the bottom line for sure, but it's not part of your normal day-to-day operating costs.
And here it is. This is the entire logic in one simple, beautiful formula. You take all your money in, that's your revenue plus any gains, and you subtract all your money out, your expenses plus any losses. Whatever is left over, that's your net income. That is the famous bottom line. Every income statement on the planet, no matter how complicated it looks, boils down to this exact equation.
So now we have the basic building blocks, but how do you actually put them together? Well, there are two main ways to do it.
a simple, single-step version, and the much, much more insightful multi-step version that all the pros and public companies use. Let's see why that multi-step approach tells a way better story.
Well, exactly what it sounds like. It's just one simple subtraction. All the money that came in minus all the money that went out equals your net income. It's quick, yeah, but it hides all the juicy details. The multi-step statement, though, that's where the real analysis happens. It's like a story with different chapters, revealing critical numbers along the way, like gross profit and operating profit, that show us how the company is actually making its money.
The best way to think about a multi-step statement is like a profitability funnel. Right at the top, you pour in your total revenue. The first filter you hit is the direct cost of what you sold, which leaves you with gross profit. This number is huge. It tells you how profitable your actual product is before all the corporate overhead. Next, you subtract all the costs of running the business, marketing, R&D, salaries, to get to operating profit. This tells you how healthy your core business is. And then finally, after interest and taxes, you get to the net profit at the very bottom. Each step gives you a new layer of insight.
Okay, theory is great, but let's get our hands dirty. We're going to use this exact multi-step framework on a real-world titan, Microsoft. We're going to walk through their actual income statement for the fiscal year ending in June 2025, just like a consultant would, to see what the numbers really tell us about their business.
Let's start right at the top. For the fiscal year, Microsoft's total revenue was, wait for it, $281.7 billion. Just let that number sink in for a second. That top-line number is the total value of every single thing they sold in 12 months. It's an absolutely massive number, and it sets the stage for everything else. But the real question is, how much of that did they actually get to keep?
Well, of course, they don't get to keep all of it. The first thing that comes out is the cost of revenue. That's what it directly cost them to deliver their products, and that was $87.8 billion. Subtracting that leaves a gross profit of $193.9 billion. This gives us a gross margin of nearly 70%. For a company this huge, that is incredibly healthy. It really shows you how profitable software and cloud services are, where making one more copy costs almost nothing.
All right, on to the next level of our funnel. From that massive gross profit, we now have to subtract the costs of actually running the business. These are the operating expenses. And for a company like Microsoft, this is where you can see their strategy in plain sight. Huge investments in research and development to win the AI race, massive spending on sales and marketing to grow their cloud business, and all the general overhead.
After you take out all those big operating costs, Microsoft is left with an operating income of $128.5 billion. Now, this is arguably the most important number on the whole statement. You'll hear it called EBIT, that's earnings before interest and taxes. And why is it so important? Because it tells you how profitable the core business is all on its own, without any noise from how the company is financed or taxed. It is the purest measure of how well the business is actually running.
And finally, after we account for a few other things like interest payments and a very large tax bill, we arrive at the famous bottom line, a net income of $88.1 billion. This is the number that gets all the headlines. It's the final profit. It's the amount of money the company could, in theory, just add to its bank account after every single bill has been paid. Just an incredible performance that shows the sheer power of their business model.
Seeing a number like $88 billion is one thing, but the real power of the income statement comes from how different people use it to make huge decisions. This isn't just some boring accounting report. It's a strategic weapon used by investors, managers, and lenders every single day.
If you're an investor, the income statement is like a doctor's report. You look past the simple, is it profitable, and start asking tougher questions. Is that profit growing? How do their margins stack up against Apple or Google? The details in that multi-step statement show you how good management is at their job and what the company's real competitive advantages are.
Now, if you're inside the company, the income statement is your playbook. By looking at revenue and expense trends, managers can answer critical questions. Is our gaming division actually making money? Are we spending too much on marketing in one region? The answers guide every big decision, from expanding into new countries to cutting costs or even shutting down an entire product line.
And what about banks or anyone who lends the company money? Well, they're looking at the income statement to figure out their risk. They need to see steady, growing profits. They're checking to see if management is keeping costs under control, because ultimately, they have to believe that the profit they see today will turn into real cash tomorrow to pay them back.
So in the end, it all circles back to this one simple, powerful truth. Every single number, every calculation, every ratio on that page exists for one reason: to tell you, clearly and without a doubt, whether the business won or lost the game of making money over a period of time.
But you know, the real skill isn't just reading the story of what happened last year. It's using all those details, the trends in profit margins, the investments in R&D, how efficient the operations are, to build a picture of the future. The income statement gives you the facts of the past. The real question now is, how will you use it to predict what happens next?